Today, the DFA Daily to the 3rd of February 2021. Relax, the news is good. Hello again, it's Martin North from Digital Finance Analytics. Welcome to the latest post covering finance and problem news with a distinctively Australian flavour. There's a great swathe of information out, and there'll be more later in the week. And I think at a superficial level at least, you'd say things are on the mend. However, there are still some questions that we should explore, and I want to do that today by looking at some of the commentary that's come out over the last day or so. I'm going to start with a piece in news.com.au by Tarek Brooker. In fact, Tarek and I will be chatting again next Friday, and I think we will be able to explore this further. But nevertheless, his article is actually quite interesting. It's headlined, "Dire Warning for Aussie House Prices as Market Continues to Grow Despite COVID Pandemic." He says, "We were warned house prices could drop by a whopping 32%. But they stayed firm. But now there's a stark warning about what could happen next. When outsiders think about Australian culture, they might think of laid-back people defined by sun, sand and backyard barbecues. But amid the widely held stereotype of Aussies, there's a part of our national identity that's often overlooked, our nation's collective obsession with housing. From our airways being filled with content like Selling Houses Australia and Location, to the millions of trips made by Aussies to the local Bunnings every month in order to spruce up their home or garden, there are few things that can grab our attention as much as our homes. When the coronavirus pandemic first began to impact Australians in March last year, concerns about potentially large drops in housing prices quickly began to build as the true scope of the crisis became clear. In April, SQM research concluded that if a worst-case scenario occurred for the economy and lockdowns lasted for 6 months across the country, a 30% drop in housing prices was on the table. In May, the Commonwealth Bank followed, warning that a prolonged downturn could result in housing prices falling by up to 32%. Yet, here we stand, more than 8 months after these downside predictions were made, and housing prices are significantly higher now across most of the country. But how did Australia go from facing down potentially the most devastating house price crash in more than a century to rising speculation of a nationwide housing price boom? In short, the Morrison government, the Reserve Bank and banking regulator APRA threw an entire Bunnings worth of kitchen sinks at supporting the property market. In cooperation with APRA, the banks allowed more than 493,000 mortgages to be deferred, with over 118,000 mortgages still deferred according to the latest data. The Morrison government committed to $507 billion in stimulus policies, encompassing the JobKeeper program and JobSeeker supplement, among others. And at the same time, the Reserve Bank committed up to $200 billion in near-term, pretty much free, 0.1% interest funding for the banks, at a time when bank funding costs were spiking due to rising risks in the financial markets. To put these measures into perspective, the entire Rudd-Gillard global financial crisis era stimulus package was $51 billion spread over 4 years. But where does that leave a property market that has been protected by a wall of more than $700 billion in support commitment by the RBA and the Morrison government? The sheer scale of support for housing prices led property analyst and SQM research managing director Louis Christopher to conclude that they, the government, will never let a housing crash happen in this country. While the forces deployed in protecting housing prices are indeed vast, there are also a number of rising risks on the horizon after a year defined by the so-called extend and pretend economy. With the RBA cash rate at 0.1% and global interest rates bouncing off the lowest levels in all of history, there is rising speculation that interest rates can only go up from here. In the United States, analysts are already warning of rising American mortgage rates as government borrowing costs begin to rise from record lows. While the RBA has committed to keeping rates low for 3 years using its bond buying program to artificially suppress interest rates. At the end of the day, it's the global bond market that is the ultimate decider of the direction of interest rates. As it stands, rate rises are seen as unlikely for Australian borrowers, but with many economists predicting inflation to rise, in some cases significantly, interest rate hikes cannot be ruled out in the coming years. Despite a level of government expenditure that makes multiple years of World War II look positively thrifty by comparison, there are still a number of economic indicators flashing warning signs. A survey conducted by lobby group Small Business Australia found that 415,000 small businesses were on the brink of going bust. If even a fraction of these businesses signalling distress were to close their doors for the final time, it's likely that the government's positive economic forecast would be in jeopardy. Meanwhile, beyond our relatively virus-free shores, the world continues to grapple with the pandemic. In Europe, EU leaders are warning that mutated strains of the virus will keep the continent in longer and potentially stricter lockdowns with no clear sense of when restrictions will be lifted. And in financial markets around the globe, market indicators continue to flash warning signs not seen since the peak of the dot-com bubble almost 2 decades ago. As a sense of market euphoria and a feeling that investors cannot lose due to central bank intervention continues to spread, which takes us to life after the kitchen sink. Among housing analysts and economists, there's still a growing consensus that the government and RBA's kitchen sink level intervention will not only result in prices not falling, but a housing price boom in the months and years to come. But amid the housing market confidence, there are also risks ahead. From a slowing global economy due to mutated strains of the virus spreading around the world, to financial market contagion overwhelming the Morrison government's interventions in the housing market. While there is the relative certainty that the RBA and the Morrison government will continue to attempt to protect housing prices, the most sacred of sacred cows in Australian life. In a world increasingly defined by the unexpected, there are also downside scenarios where no amount of kitchen sinks will be enough. Good work, Tarek. Nice summary of where we are. So now let's go on and look at the latest data from the Australian Bureau of Statistics relating to dwelling approvals, which showed a massive rise. They said that the seasonally adjusted estimate for total dwellings approved rose, wait for it, 10.9% in December, and private sector houses rose 15.8% in seasonally adjusted terms, while private sector dwellings excluding houses rose just 2.3%. The seasonally adjusted estimate for the value of non-residential building approvals rose just 10.1%. And so there were just over 19,537 dwellings approved, of which 13,638 were private sector houses. The chart, of course, highlights the significant peak, and the total number there, seasonally adjusted, was 19,537. And turning to the dwellings approved by type, you can see there that private sector houses roared ahead, 13,638, while units and other non-houses were pretty slow at 5,625. This is a house-led boom. And they said that approvals for private houses were strong across the country, with Victoria, South Australia and Western Australia all reaching record highs in seasonally adjusted terms. New South Wales recorded its highest private sector housing figure since March 2000. and it was Queensland's highest since September 1994. And approvals for private sector dwellings excluding houses remained at subdued levels, rising just 2.3%, but remaining 19.3% lower than December 2019. Now, dwelling approvals rose in Tasmania, up 66.5%, Queensland 24%, South Australia 16.7%, Victoria 8.6%, Western Australia 7.8%, and New South Wales just 1.8%. So this is not spread uniformly across the country. And looking at the value of buildings approved, new residential buildings rose by 1.4%, and total buildings by 4.9%, with a significant rise in non-residential buildings and alterations and additions to residential buildings. That's another sign of the government stimulus. Remember that there is stimulus for new people to buy off the plan properties and also to make improvements for existing properties. And here is the chart of building value. Residential, 6,981 million in December, whilst non-residential was 3,771 million. And they concluded the value of total buildings approved rose 4.9% in December. In seasonally adjusted terms, the value of non-residential buildings rose 10.1%, having fallen 27.7% in November. It's a very volatile series. And the value of total residential buildings approved in December was 2.3% higher. The value of new residential buildings rose 1.4%, while the value of residential alterations and additions rose 8.1%, and the value of residential alterations and additions reached a record high in December of $941.6 million. So you can see a direct line of sight here to the significant government stimulation, which of course is what Tara was talking about earlier on. Now, elsewhere today, Philip Lowe, the governor of the RBA, made a presentation to the Australian Press Club in Canberra, and there are a number of thematics which are worth picking up on. And he started by saying that the world has changed tremendously since his address back in February. Of course, that was pre-COVID. A lot of water has gone under the bridge. And he highlighted the national response and how all the entities of government and finance have pulled together. And as a result of that, he's saying there's an earlier and stronger bounce back. There have been very significant economic costs. The downturn actually was not as deep as they were initially forecasting, and employment growth has been strong, as have retail sales and new house building. Indeed, across many indicators in GDP, the outcomes have been better than their central forecasts, and even better than their upside scenarios as well. And here's an example. Unemployment was forecast to end 2020 at close to 10% and to be still above 7% at the end of 2022. In their upside scenario, the unemployment rate was expected to end 2020 a little lower than 10%, but still be around 7% later this year. Thankfully, he said, the actual outcome for unemployment has been much better, with the peak now looking to be behind us and the unemployment rate ending 2020 at 6.6%. And he went into some detail as to why those outcomes are better than expected. The first success, he says, was that we managed in Australia to contain the virus. Now, sure, there were restrictions on activity, and the fact of the matter is the health of the population and the health of the economy are inextricably linked. The second factor is the very significant fiscal policy support in Australia, which, as measured by the change in aggregate budget positions, is almost 15% of GDP. Most of the support was delivered by the Australian government, but the states and territories also played a role too. The support has been more substantial than was assumed in August, and did make a real difference, he said. And there was also a positive interaction with better health outcomes, which has allowed the policy support to gain more traction than would otherwise have been the case. And he said the third factor is that Australians adapted and innovated. When the virus first came to our shores, many people hunkered down, but as days wore on, households and businesses adjusted and changed what they did and how they did it. And this resilience is helping us to keep the economy going and to keep people in jobs. Many firms changed their business models, moved online, used new technologies and reconfigured their supply lines. And households adjusted too. Online spending surged, increasing by 70% over the past year. And he said these changes in our spending patterns have been challenging for many businesses, but the ability and willingness of Australians to keep spending has also helped the overall economy. But then he made the point that there's still a way to go. The fact of the matter is there is still very substantial spare capacity in the Australian economy. The employment rate is higher today than it's been for almost 2 decades, and many people cannot get the hours of work they want. And in terms of output, we remain well behind where we thought we would have been back when he spoke in February. When the national accounts are published for the December quarter, they're likely to show that the level of GDP is 4% lower than where we thought it would be a year ago. That's a big gap, he said. And on the nominal side of the economy, it's also a fair way to go. In underlying terms, inflation is running at 1.25%, well below the medium-term target of 2 to 3%, and wage growth is lowest in decades, with the wage price index increasing by just 1.4% over the past year. Given the spare capacity that currently exists, these low rates of inflation and wages are likely to be with us for some time, he said. So then, thinking ahead, he says we can draw some comfort from what has just happened. As in the case of 2020, much depends upon the path of the pandemic. The development of the vaccines in record time could certainly help. It has reduced some of the uncertainties. But the outcome, he said, is not assured. The global rollout of the vaccine faces challenges, and there are a range of other uncertainties about the global economy, including trade tensions. We hope for the best here, but he says we have to be prepared for further setbacks. Now, the RBA will be releasing a full set of updated economic forecasts on Friday, but there are a few key numbers that he presented. In preparing the forecast, we've assumed a rollout of the vaccine in Australia in line with the current government guidance, and that international travel remains highly restricted for the rest of this year. Their central scenario is for the upswing in the Australian economy to continue with above-trend growth over the next couple of years, and GDP is expected to increase by 3.5% over both this year and 2022. He said, given the recovery we've seen so far, we are expecting the level of GDP to return to its end 2019 level by the middle of the year, which is 6 to 12 months earlier than they'd previously expected. That said, they're not expecting the level of GDP to return to its previous trend over their forecast period, and that's largely because of lower population growth. When they prepared the forecast a year ago, they were expecting the population to grow by 1.6% over 2020 and 2021. The actual outcome is likely to be around 0.2% in 2021. That's the lowest since World War I. And the slower population growth has a direct effect on the size of the economy and means that we're not getting back to the previous trend any time soon. In per capita terms, we expect more, but not all of the lost ground will be made up, he said. And this has implications for the labour market. They're expecting the rate of unemployment to continue to decline. In the central scenario, it's expected to reach 6% at the end of this year and around 5.25% by mid-2023. Job vacancies, job ads, and business hiring intentions are at high levels, which suggests continuing solid employment growth, he said, over the next few months. Beyond that, some slowing in employment growth is to be expected when the JobKeeper program comes to an end in March. And that has significant ramifications on wages growth and inflation. Both are expected to remain subdued. In the central scenario, wages growth is forecast to pick up from its current low rate, but to do so only very gradually and still well below 2% at the end of next year. And that's to do with the spare capacity in the economy. Inflation in underlying terms is also forecast to stay below 2% over the next couple of years. That's the central forecast in 2021 at 1.25%, and for 2022 it's 1.5%. In headline terms, inflation is expected to spike to around 3% in the June quarter, largely reflecting swings in the price of childcare and some other administered prices, but then to return to below 2% by the end of the year. That's an important observation. There's a lot of manipulation, of course, in the figures at the moment. The underlying numbers will remain low for a long, long time. They're also looking at publishing downside and upside scenarios. In the downside scenario, the combination of further sporadic domestic outbreaks, a delay in the rise of the vaccines, and a worsening global outlook means things deteriorate, whereas the upside involves further good news on the health front with a strong pickup in consumer and business confidence. Now, he says there are two specific issues relating to the forecasts. The first is how households respond over coming months to the tapering of the fiscal and other support measures. Unusually for an economic downturn, growth in household income has been quite strong, largely reflecting the support provided by fiscal policy. Much of this extra income has been saved, with the household saving ratio surging to 22% in the June quarter. This largely reflects the limited spending opportunities during the lockdowns, but it also is a response to uncertainty that people felt about the future. These extra savings have strengthened household balance sheets, which means that many people now have bigger financial buffers than they had previously. But of course, I have to highlight the fact that my stress data shows not all households are well supported. There is a considerable proportion who are in some difficulty. The question then, of course, is what happens next. Over the next 6 months, aggregate household income is expected to decline as the pandemic support payments unwind. Normally when income falls, so too does consumption. But we're not, he says, in normal times. The extra savings over the past 6 months and the bigger financial buffers can support future spending. People will have more freedom to spend as restrictions are eased and will be more willing to spend as uncertainty recedes. So they are expecting the recovery in consumer spending to continue. But there are some risks too. On the downside, further bad news on the health front could see additional restrictions on activity and a renewed desire to save. And on the upside, positive news on health and jobs could see people seeking to catch up on spending and run down their extra saving buffers quickly, so they'll be watching that quite closely. And of course, the other important factor bearing on household spending is the housing market. They discussed how falling housing prices was one of the factors that had contributed to sluggish growth in 2019. The dynamics of the housing market now look to be in a different phase, with prices, he says, rising across most of the country recently. It remains to be seen how long this will continue, but substantial increases in asset price support household balance sheets, he said, and encourages spending through positive wealth effects. Higher housing prices can also encourage additional residential construction. But, he said, as housing prices rise again, they'll have to monitor lending standards closely. We would have to be concerned if there was a deterioration in those standards, but he said there are a few signs of this at the moment. Just remember, responsible lending is due to be abolished at the end of March. And he also went on to talk about the outlook for investment. Prior to the pandemic, there were concerns about a protracted period of low level of non-mining business investment. Not surprisingly, when the pandemic hit, investment fell further. And faced with other more significant uncertainties and drop in demand, many firms deferred investment plans. He says we're yet to see the same signs of recovery in private investment that we have witnessed in household spending. Investment, though, is expected to pick up as uncertainty recedes and demand increases. An increase in private business investment is not only needed to support the economic recovery, but is also required to build the productive capital stock that is needed for our future. So this is an issue which, again, they're going to watch closely. And then finally, he touched on monetary policy. And of course, as I reported yesterday, no change to the cash rate. significant further activity with regard to quantitative easing, and the RBA balance sheet growing to, wait for it, 330 billion, and with a further substantial increase in prospect. And the second conclusion, he said, is that very significant monetary support will need to be maintained for some time to come. It's going to be some years before the goals for inflation and unemployment are achieved, so it's premature to be considering withdrawing the monetary stimulus. And that, of course, explains the continued bond program. He said that over the last 3 months, experience has shown that the bond purchase program helped to reduce interest rates and also took the Aussie dollar lower than it would otherwise been, although, of course, it's still very high. And Australia's government bond markets also continue to function well, and the available evidence is that further purchases will not be a source of market dysfunction. In terms of other central banks, most have recently announced extensions of their bond purchase programs, many running over perhaps the next year. Given this, if they were to cease bond purchases, then there will be an unwelcome upward pressure on the exchange rate. And that, of course, is the point. As central banks around the world all do quantitative easing, issue more bonds, we must have to join the dance, or if we don't, then the dollar gets taken to the cleaners. We are, frankly, hostage to bigger players like the Fed and the ECB and the Bank of England. The fourth conclusion is that the term funding facility will be maintained. Banks are able to draw on the facility up till the end of June, which means that they will have the benefit of low-cost funding out to mid-2024. The board will consider extending the facility further if there was a marked deterioration in funding and credit conditions. So the banks will continue to be supported by the RBA. And the 3-year target yield for Australian government bonds will be maintained. He said the target had helped to anchor the Australian yield curve and reinforce their forward guidance regarding the cash rate. Later in the year, he said the board will consider whether to shift the focus on the yield target from the April 2024 bonds to November 2024. In considering this, the board will be giving close attention to the flow of economic data and the outlooks for inflation and jobs. No decisions yet being made. And he said the final conclusion is that the cash rate will be maintained at 10 basis points for as long as necessary. The board has no appetite to go into negative territory and has done as much as it can reasonably do with interest rates. But before increasing the cash rate, the board wants to see inflation sustainably within the 2 to 3% target range. Meeting this condition will require a tighter labour market and stronger wages growth than we are currently forecasting. He said it is difficult to determine exactly when this condition might be met, but based on the outlook, it is not expected to be before 2024, and it could be a lot longer than that. So he said the message is this: interest rates are going to be low for quite a while yet. And the Reserve Bank is committed to providing the support the economy needs in its recovery from the pandemic. So there you have it. Clearly spelt out by the Reserve Bank, clearly optimistic about what's going on, but also highlighting some of the risks around the virus. And of course, if the virus comes back, as my scenarios indicate would happen, the economy would deteriorate. So we are still not out of the woods, which takes us to the question of consumer confidence. And the ANZ Roy Morgan research came out today, and they said that consumer confidence rose a modest 0.8% last week, consolidating last week's bigger gain. The gains came on the back of an improved assessment of financial conditions, whilst economic conditions pulled back following its strong surge in the prior week. Confidence is now close to its long-run average. And it's worth noting that the news of the lockdown of Perth and Western Australia came too late to impact the survey, so it'll be interesting to see how that impacts it ahead. But their data highlights that confidence levels are back closer to the neutral setting than previously, but still have a bit of a way to go. So we'll have to watch this quite closely ahead. And so, in summary, from all that data, we can say that the Reserve Bank is portraying a very optimistic story in terms of what may happen ahead. There are still considerable risks, of course, to that story, health-related and beyond. And I come back to Tarek's point in that first article that we discussed, which is that, of course, the massive amount of government support is supporting the economy at the moment. And the question ahead is, what happens as that is withdrawn? How much can be withdrawn? How much can be repaid? And how much will that dent consumer confidence and business confidence? And by the way, referring to Tarek's article, he's dead right. The small and medium enterprise sector is where I think the cracks are beginning to appear even now, but it will take some months for those to flow through. So net-net, things are not too bad. We're certainly in a better position than many other countries around the world. But as for whether we're out of the woods, it's probably too soon to say. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.